Hello friends, my name is Dheeraj Vaidya from wallstreetmojo.com. This is part 31 of our ratio analysis videos, and in this installment we learn all about the bid-ask spread. In simple terms, the bid-ask spread is the difference between the ask price, that is the lowest price of the stock at which the seller is willing to sell, and the bid price, that is the highest price at which the buyer is willing to purchase a security. So in this tutorial, we basically have four objectives. Number one, we learn what bid-ask spread actually means. Number two, its formula and calculations. Number three, we'll calculate bid-ask spread for Colgate. And number four, its interpretations and how do you use it. But before we jump into the tutorial, a quick reminder. We'll be needing all the working files of Colgate case study for this video. So if you haven't downloaded it yet, please do so from the link in the description box below. And also, to keep yourself updated with investment banking and core finance concepts, please do subscribe to our channel, Wall Street Mojo. So let's get started. What is bid-ask spread? Bid-ask spread is a part of the ratio analysis framework, and it comes under the external liquidity risk category. When we are looking at bid-ask spread, we are usually talking about those companies or those stocks which are listed in the stock market. By virtue of their listing, we should be able to buy or sell those stocks. We are not talking about those companies which are private companies whose shares are traded in a private market negotiated through private deal. We're not talking about those type of companies. We are saying that only listed companies is where we will look at the bid-ask spread. Now, coming to what exactly it means, the first step is to understand what is the bid price and what is the ask price. Now, what is bid price? Bid price is what the buyer is ready to pay. The price which the buyer is ready to pay. And this is the price that the seller is ready to sell at. Okay, so in the context of stock markets, the price at which the buyer is ready to buy the stock is called as bid price. Ask price will be the seller is ready to sell at that price. Let's imagine a scenario where, let's say, we're talking about a stock A, whose bid price is, let's say, $20 and ask price is $20. What happens in this case? When the bid price is same as the ask price, the transaction actually happens, right? Because both the parties kind of agree on the prices, right? So that's called as a bid price and the ask price. And the transaction will only happen when the bid price and ask price will match. But let's imagine a scenario where there is a difference between the two. So if there is a difference, say for example, if the bid price is, let's say, 20 and the ask price is, let's say, 50. Now what happens here in this case? So this means that the seller is ready to only sell at the stock at $50, but the buyer is ready to buy the stock only at $20, right? So what will happen in this case? No transaction will happen, right? Until and unless, there's one of the party between the two who agrees change their own prices. If you look at this case, the bid-ask spread is nothing but the ask price minus the bid price. So here is the formula to look at. It's simple. Ask price, what the seller is asking, and bid price, what the buyer is willing to pay. Here is the bid-ask spread. The bid-ask spread in this case is 50 minus 20, that is $30. Now that we have understood the calculation part of the bid-ask spread, let's look at the overall implications as to how the stock market prices increase or how it decreases actually. Let's say in a scenario where there are more buyer interest, okay, in the stock market, and sellers are not ready to sell. So that means what will happen is, if there are more people who would like to buy the stock, what will happen? They will pump up the bid price, right? So they will try to attract the sellers by bidding higher. So they might bid at 30, okay, to start with, and then again they'll look at whether the seller is ready to sell. So if they're very limited sellers and they don't want to sell at all, then again the buyers will have to kind of increase this bid price again and again if they really want to buy the stock. So at the end of the day, what happens is that the final transaction might happen at a price which is the ask price. With this, the transaction will happen. In this case, the transaction will happen, but what has happened by virtue of this transaction is the stock prices have increased. This might happen, and if this happens, this is because of higher buyer interest, and sellers are not ready to sell it all. And then there could be a totally opposite situation where there are more sellers and less buying interest. So what will happen in this case will be totally opposite of what you just saw. So let's say if the buyers are ready to buy at 20 and the ask price was 50. Now more sellers, if they come, they want to sell, dump their stock. They feel that the stock, there was some negative news that came in the market and they want to sell the stock immediately. So they will keep on lowering their prices. When they keep on doing that, they might reach a point where they will touch the bid price, and that's where the transaction might happen. So in this case, the stock price will decrease, and in the first case the stock price will increase. Okay, so I hope you understood the overall implications of the bid price and the ask price and how they are matched. And basically the difference between the two, ask price and the bid price, is known as the bid ask spread. There's one more interpretation about the bid ask spread which I forgot mentioning here. The bid ask spread, if it is high, let's say in this case, this is pretty high, right? Compared to the stock prices, the bid and the ask price, the spread of $30 is pretty high. What does this mean? This means that the buyers and the sellers are not agreeing to the transaction at all. So they have to if they have to agree, they have to make a lot of efforts. So in this case, there will be a lower liquidity in the market. What do we mean by lower liquidity? Transactions will be infrequent. And even if the transactions happen, there will be price volatility because there are not many buyers and sellers who agree. So this is what we will see usually when there is a higher bid ask. But let's assume that there is a totally opposite scenario where the bid ask spread is pretty low. Say for example, if it is the ask price is 20.5. What happens in this case? Now, since the spread is very low, obviously the buyer, if they really want to buy the stock, they might not have much problems in increasing the price by another 50 cents. The transaction will happen very frequently. And since the spread is low, it will lead to higher liquidity. Liquidity means the total volume of stocks that will be traded in the stock markets will be higher. Transactions will be frequent and price volatility will be lower, right, as compared to the place where bid ask spread was very high. Okay, so this is another important interpretation that you need to keep in mind. Let us now look at Colgate's trading data and understand what its bid ask spread is all about. The one that is highlighted here, can you see that? That's the bid price, that is 78.61, and this is the ask price, okay, 80.30. This 1300 is the amount of shares which a buyer is ready to buy at this price. Likewise, there is this ask price multiplied by 900 means there are 900 number of shares which the seller is ready to sell at. Let's first calculate the bid ask spread. So bid price is 78.61 and the ask price 80.30. So the spread, the bid ask spread, is equal to 80.30 minus 78.61, that is 1.69. So there are a couple of observations that we can make. So as compared to the absolute stock price, that is around 79.90, the spread of 1.69 is very, very low. What happens when the spread is very low? There are very frequent transactions that would definitely happen. Then we said that the volatility in price will also be very low. So if you look at this days range, that will help you understand the volatility in the price. The days range is 79.11 to 79.97. So it's pretty much in that band, right? So this means that the price is not, the stock is not volatile as such. That's another implication that we can have because of the lower bid-ask spread. And the third is that the volume of transactions, of course, because the spread is low, will be higher. So you can see here the volume of transactions here. This is around 3.7 million. That's a fairly high volume of transactions to look at. What it means essentially is that lower the bid-ask price, lower is the volatility, higher is the transaction, and it is much easier to sell such kind of if you are the owner of that. I hope you understood what is the bid-ask spread and how you calculate the bid-ask spread and its interpretations. I hope you found this video to be useful. Please do like and share. And if you have any feedback or want to suggest a topic for any future video, then you may do so by writing about it in the comments section. Also, we come up with interesting videos on investment banking and core finance topics regularly. So if you haven't subscribed to our channel yet, please do so by clicking on the subscribe button below so that you can get the notification about our latest videos. I hope you enjoyed the video. Have a nice day.